Hey, Jamie Tay here, founder of PT Biz, and today we are talking about how to build wealth as a clinical entrepreneur. So the idea of wealth building is interesting. I think for most of us, we just honestly are trying to have enough income to do the things that we need to do with our families, right? And live a life that we want. And when you have a job that is probably just the goal of most people, and maybe you get a chance to save a little bit of money on the side, and hopefully you are. But if you decide to take the risk to go into business for yourself, and you decide that you're going to, really work towards building this business, in this case, a clinic, you put yourself in a position to have the opportunity to be able to make far more money than you could working for somebody else if you're successful. And that is just the reality of the risk versus reward. That's any business. And in this scenario, we're going to talk about a clinic and how that can be a wealth building tool for you. Now, I'm going to talk about 5 steps that I see that you should focus on in different portions of this journey of building a clinic and entrepreneurship. So, number 1, when you get started, and this was advice that I got from a mentor that at the time I thought was pretty aggressive, but I took it anyway because I thought that he knew better than I did. And it turns out that he did. And that was to stop investing in anything outside of your business. So when I started my practice, this mentor I had said, hey, listen, anything you're investing outside of this, anything you're putting in towards retirement or any sort of investment that you might have that is not your core business, you need to stop investing in that and you need to redirect all of that to your business. And he was very much right about that, but I had a very hard time with that. I'd actually started putting money into, at the time, like Roth IRA investment vehicles when I was like 17 years old. And I'd been putting money into that since then, right? I mean, at the time when we got out of the Army to start Athletes Potential, I was 29. So for 12 years, I'd been putting at least some amount of money into these Roth IRA vehicles. And for me to stop, that was pretty hard to do. It was just something that was a habit that I'd built. And I thought a really important habit that I'd built, which for sure it is. But in stopping doing that and taking the money that I would put towards that and putting it back into, building the business up, getting help on learning how to run a business, equipment for the business, investing in marketing for the business, all these things that we could put that money towards, it helped us accelerate the growth of that business much faster. And for us to go from just starting to then having 3-4 providers within a couple of years with a standalone space and being able to essentially triple, if not quadruple, what I was making whenever I was in the Army as a captain when I got out. That's what happened over the course of a couple of years. And there was no investment in anything outside that. And there was a ton of investment back in the business. It's because the best thing you can do is grow your income stream, is grow your business to a point where you have more profitability and you're able to pay yourself more from that business. These are not software companies that are going to have this huge pop on the exit when you sell. Like, they're not going to sell for a 10x multiple of top line revenue. Like, that's not going to happen. But what these do have is great cash flow. And they're really, really solid businesses they're hard to ruin, honestly. They're hard to mess up because the problem exists that people have injuries. People want to work on their health and wellness. They don't change very fast, right? So kind of the idea of what goes up fast comes down fast. Like, these don't change very quickly. And they do spit off a lot of cash flow. They can be quite profitable if run correctly. So step 1, stop investing in anything outside of your business until you hit step 2, which is you grow this until you don't know what to do with all the income that you have, right? So let's say you're used to making $80,000 a year, and now all of a sudden you're making $250,000 a year in take-home income from the business as you've grown this. And that could take a few years to grow to that point, by the way. So, and everybody's a bit different. I've seen people do that in 18 months. As far as take-home income is concerned, I've seen people that takes them 5-6 years to get to the same place. So it just depends. It depends on your context, your skill set, your environment, your willingness to really learn how to be a good business owner. That's the biggest difference that I see. So once you get to this point, and let's assume and this is a big assumption, by the way, that you don't just start spending everything that you make. And this is probably the biggest mistake that people will make in this process. And I'll say that this isn't necessarily part of the 5 things that I'm going to talk about, but you can't necessarily do this without it, right? Like you could make $1 million a year, but if you spend $1 million a year, you end up in the same place. I don't even know how you'd spend that much money, to be honest with you, but I'm sure you could do it. And you would still end up you'd be at net zero, right? Like you wouldn't have any more than you started with. And it's not what you make, it's what you keep. It's what you save, it's what you invest, because that builds wealth outside of your income streams, which is your business, right? Or the volatility of the business. And it's really important. So let's say you're used to making 80, maybe, lifestyle increases, you have a bit of lifestyle creep, and now you're living like you make 100,000, but you make 250. There's a big difference there. There's a couple big differences. So number one, obviously you have a delta of $150,000 in terms of what you're making versus what you're spending. The other big thing, taxes. So you pay more taxes. So you're not going to initially have that $150,000 net. You're going to have a reduction in that based on a higher tax bracket that you're in, but you're still going to have quite a lot of money that you can now invest into other things. But don't stop reinvesting in the business until you hit a point where you literally feel like you don't know what to do with the income that you have because you have far more than what you're spending. And even then, you should still continue to reinvest in your business, right? This is over a decade in. I still work with mentors. I hire coaches for things that I'm trying to learn because I'm not done. I still have a lot to do. I'm still trying to learn a lot. I'm trying to implement a lot. And I view it as an investment in the business, just like I did whenever I stopped investing outside of it to double down on our practice so that we could grow it. And it was the best decision, the hands down best financial decision that I ever made, period. That's it. There's nothing I look back on and say, holy shit, that changed the trajectory of my family's life the way it did as far as me starting a clinic. And it could be any business, I guess, doesn't really matter. But like me learning how to become a business owner was the best investment that I've ever made, ever. So you got to look at your business as that. It's an investment. So put your money back into it instead of putting into Google or Apple or the S&P 500 or whatever. Put it back into your business and view that as a company that you're investing in, not necessarily just your little clinic that you started, right? It's more than that if you treat it that way. So once you get to the point where you have more income you know what to do with, that moves to step number 3. Okay, so step 1, invest in the business until you've grown it a ton. 2, get to a point where you have far more income than you know what to do with. Step number 3 is to stay away from a mistake that I see a lot. And this actually is something that I've made mistakes with this myself. I've recently had clients that we work with that have reached out about tax mitigation strategies and tax strategy and how they can pay less in taxes. And I will say this, step number 3 is do not look for investments that are based on tax efficiency first initially. And there's a lot of information that you can get exposed to that usually has to do with things like alternative investments, oil and gas, clean energy, real estate syndications, things of that nature, or maybe it's even physical real estate that you own where you can use tax advantages in order to be able to reduce your taxable income. These are real strategies, and I've implemented some of these myself, and I've paid a handful of people to be strategists and consultants to look at what we're doing and give us a better idea of how we can reduce our taxable income, which sounds great, okay? Sounds awesome. But as a busy entrepreneur, here's what I want you to think about. If somebody says, hey, here's these cool strategies that are gonna reduce X amount in taxes, that's awesome. On paper, that sounds great. The implementation of those things, in my experience, is far more energy costly, time costly, mental bandwidth costly, and potentially financially costly unless you do a great job of vetting this investment or getting the right piece of real estate that you can have this pretty hands-off the cash flows, which is very hard to find, and getting a tax benefit along the way. The other thing is many of these tax benefits are transient, meaning if you take that benefit and let's say you have a piece of property and then you sell it, you pay taxes back on that called recapture tax. So you have to be long-term hold. And if you want to continue to do it, you have to keep investing into something that is very illiquid. And here's what I mean by that. If I was to buy a property, let's say I have to put 20% down. Let's say the property costs $500,000. I have to put $100,000 down on the property. Now, if I put $100,000 down on the property, but that property saves me $40,000 in taxes, I guess technically I'm only in for 60. But I still have a lot of cash that's locked up in that, and I cannot access that if I need to. And being an entrepreneur, our income is not guaranteed. It can swing up and down, sometimes, yearly, based on how things are going. And maybe you plateau, or you have a dip because of whatever thing happens in your business, or maybe you have a great year, whatever. It's harder to plan financially what's going to happen because the business is a bit more erratic than somebody who has a job, right? That has like a W-2 job and they know what they make every single month. So number 3 is when you go to then start to invest outside of your business, don't do it based on tax first. It should be, is this a solid, safe investment? And then what are the tax implications, if any, associated with that? I can tell you I have lost more money trying to save money in taxes than basically anything that I've ever done. And that sucks to say that. It's not a good lesson learned. So hopefully you can hear what I'm saying and not do the same things and not get caught up in, oh, this sucks to pay this much and whatever. It's just like, listen, sure, but it's the cost of doing business with the opportunity to have businesses in the US. That's just the way it is, okay? That's the way that I look at it now, because it's not really worth my time. And I want to be as efficient as I can be, but I don't want to do these wildly complex strategies that are going to take a significant amount of time, or me to have a team that I have to try to implement. I already got shit to do in businesses. Why am I going to try to do something outside of it that's going to take a ton of time that's going to be far lower of a return on my time and attention? So step 3, do not try to invest in something for tax purposes first. It always has to be a solid investment first. If it's a good tax advantage, it's icing on the cake. Okay, number 4, keep it super simple and low risk, ideally. Okay, so I'm not going to tell you what to invest in specifically, but what I will say is if you can put money aside into things that are very easy for you to just put it into, and you don't have to think about it at all, and it's in a safe, conservative, investment, and it's liquid, meaning if you needed access to it, you could sell it pretty quickly. That's usually the best place to put it. Now, that could be maybe your company has your own 401k. Maybe you put it into a Roth IRA. Maybe you put it into a brokerage account that's taxable, but it's taxed after, and it grows tax-free unless you sell it. And you can put this into very conservative things that still have good rates of returns. This could literally be a ETF or an electronically traded fund that's a basket of companies, that are like the S&P 500, so 500 biggest companies in the US. You could put it into even broader index funds than that are basically every stock in the world, right? And it just depends on what you want to do. And I'm not here to tell you exactly what you should invest in and how much you should put in that or anything like that. But what you want to look at is taking that excess money you feel comfortable with and putting it into something very simple that you don't have to think about all the time. And this is something that I didn't do for years. In fact, I didn't have any exposure outside of the money that we had put in a 401k in the Army, like their version of it is called a TSP, and the money I'd been putting into Roth IRA since the time I was 17 in stocks. Everything else that we had was businesses, alternative investments, outside of that. And in the last few years, what I've realized is the complexity that I was adding to what I was doing was not worth it. It wasn't worth it. Because if I had just put it into something simple, my returns would have been the same, if not better. And I wouldn't have had all this additional time and effort and stress around tax season, trying to get all these like K1s from different things that you're investing in and working with accountants on the complexity and the additional cost to actually submit a return because of this. All of that, it's just not worth it, right? And at this point, for me, it's just like, whatever money that we want to invest, boom, I throw it over into these investments. It gets allocated into what I want, and then I don't really think about it too much. And that is like far better because it allows me to focus on the businesses that we have. It allows me to focus on adding value there, which can dramatically increase your take-home income, your value of your business, right? Which does have intrinsic value. And we'll talk about that in a second. I'm not even putting that in here necessarily in terms of building wealth, but for you to have something simple is very much worth it. It's very, very worth it. And because you got to keep in mind, not only are you taking yourself away from your business whenever you do things like this and these complex strategies, you're taking yourself away from your family. You're taking yourself away from hobbies and friends and free time and things that you need to do to decompress from the stressful life that is running a business. And now you add on an additional layer of stress that you don't even understand that well because you think it's a better way to save money on taxes and speed up your returns. Like that usually doesn't work out, right? It doesn't work out as well as being patient and letting things compound. So step 4 is make it super simple and automate it, right? And don't think about it. It should be that easy to do. So number 5, if you do these things, you're going to de-risk a couple things. Number 1, you're not spending everything that you make. So you have money left over to invest. You're putting into something that is outside of your business. So you're building wealth outside of your business, which, by the way, most entrepreneurs do not do this. They put everything they have. They double down over and over and over again on their business. And if that business doesn't work out or they're unable to sell it one day, they have everything tied up in this one vehicle, and it's incredibly stressful for them. Imagine if you're able to build significant wealth somewhere that is completely insulated from how your business does. It's almost like you're building the safety net outside of your business that allows you to make better decisions in your business, to have less stress in your business and in your daily life. So doing so allows you to refocus on your business and really play the game the way that you want, and maybe take a bigger swing, or maybe go for something that's a bigger vision that you have, or just be more efficient and effective with your business so that you can have a better revenue stream, a better valuation on your business. So it allows you to then refocus. So step 5 is refocus on your core asset, because at the end of the day, your ability to increase your income is directly tied to how your business does. Your ability to increase the valuation of your business is directly tied to how your business does. And you can make a strong statement that literally there's nothing you can do that's going to be as beneficial as improving that core asset. And here's why people tend to deviate from this. It's because of redundancy, of people getting bored, of people looking for something else to do, because most entrepreneurs, myself included, we're slightly ADD, or we jump around to other things. We like these shiny objects, and we want to test this new thing, and we get excited about that. And the reality is, at a certain point, your business is boring, and that's a good thing, because you're making small iterations on improving your team, your processes, your culture, improving even profitability in the business by making small improvements, or growing the size of it and improving it that way. Like whatever it is that you want to do, you can be creative in your own business. You have to search for other things outside of that. But if you can do that, I want you to think about this for a second. When someone has a job, they cannot sell their job whenever they leave. It's not how it works. Not unless you're a partner in some way in some firm or a company. You go work for a PT clinic as a clinic director, you get an income and that's it, right? And then, all right, you leave and you can't sell it. You can sell your business. You can sell a clinic. We've helped a number of clinics do so. Now, is it going to be a 10x of your top line revenue like a software company? It will not be. No. In most cases, when we look at what these businesses are valued at, and it very much depends on the size of them, but a smaller clinic, let's call it, maybe a $1 million top line clinic that's pretty profitable, maybe they're 30% profitability, somewhere in that range. Well, they're going to probably trade somewhere around, someone will buy that for probably 3 to 5 times profit. Let's call it that, right? Maybe a little bit more, a little bit less. It depends on a lot of factors, many, many factors. If it's bigger, let's say you grow to 5-10 million top line clinic and you have a few $1 million in profit, well, that's going to push you up into a higher multiple range. And that's actually a lot of money, right? I mean, I don't know what a lot of money is to anybody listening to this, but to me, that's a ton of money. If you can sell for a few $1 million a business that when you don't want to run it anymore, that's a pretty fantastic way to end your career with that business and be able to have money to then move on to the next thing that you want to do, or to retire, or whatever it is you want to do. I don't know. It doesn't really matter. But If you focus on your core business, the step 5, you make it as good as possible. It puts you in a position to increase your income, which allows you to then invest more outside your business and potentially sell your business one day. But if you don't, and let's just say you get to a point where you can't sell your business, it doesn't work out, whatever, there's no buyer for it, there's no market for it, and this is sort of worst case scenario for you. But you've created something that's, let's be honest, you've helped a lot of people along the way. You have employed fantastic people that like what they do. You've built a really cool culture, and you've created an income stream for yourself that's allowed you to invest in things outside of your business. There ain't that much to be mad about. You're in a pretty good spot. And if you can sell it, it's the icing on the cake. Fantastic, right? That's the way that I look at it with the businesses that I have, and I've even sold a clinic. And so, it's something that, to me, I think you have to look at it as it's an option. It happens. But if you can be in a position where you're not dependent on the sale of the business, it's going to help you so much in terms of stress, making the right decisions, and really focusing on the things that matter the most in the business so that it increases the profitability, which is predictable. The cash flow is predictable, and the cash flow can fund your life and be invested in things outside of it that build wealth, not tied to your business. And this is what you got to think about. Think of it like a barbell. Your business is over here. This is risk, and this is not risky, okay? If you have a ton of monetary, just income and value tied up in the risk side, you want to offset that with non-risky things. What I'm talking about, putting something in an ETF, something very simple, very safe. That way, you're not just doubling down on risk, and you've now put a barbell in place that evens that out to some degree. That's the way to think about it. So in summary, let me go through these 5 again. So number 1, stop investing in anything outside of your business. I know it sounds weird, and just double down on your business. Number 2, grow that until you have more money than you know what to do with. Number 3, do not get sucked into tax loophole first, tax advantage first, investments, especially if they sound complex and you need a team of people and engineers and tax attorneys and CPAs to help you put that shit together. I can tell you, you probably don't make enough money to do that if you are running a clinic. Number 4, all right, make it simple, make it automated. Take a portion of that money, hopefully more than you even think you can invest, like invest as much as you can over here in something that's liquid and simple, all right, not tied up in a physical asset or a alternative investment of some sort. And number 5, refocus all of your efforts on your business to continue to iterate that, improve that, make that the best business you can. It's going to increase your take-home pay. It's going to increase the value of your business. And the icing on the top for you, at the end of the day, when you're done with your businesses, maybe it's selling that and having a windfall of money on top of that, or a pop on the exit that really puts you into a position where you have true generational family wealth, okay? And even if that doesn't happen, you should be in a really, really solid financial position by doing what I've already just talked about. So I hope this helps you. This is something that, I wish somebody would have explained this to me in a little bit more simple terms. Frankly, I probably wouldn't have listened. Maybe you're like me and you're stubborn and you're just going to do what you're going to do anyway. But this comes from personal experience. This comes from mistakes that I've made. And what I wish I would have done different, to be honest with you, this is what I'm sharing with you. So I hope this helps you. If you're a clinician and you are, growing your clinic and really trying to build a rock solid business, I would highly recommend taking a look at PT Biz. This is the company that I started. This is a company that we've now helped over 1,000 clinicians work with. There's not a single person in the business education space in healthcare, as far as like physical therapy in particular goes, that's worked with as many people. And we're really proud to say that. We have alumni of PT Biz all across the country that's doing great. If you want help with your business, you want to be around a group of like-minded clinicians and really learn how to be a great business owner, to be a business owner that owns a clinic, not a clinician that owns a business. And that's a very different thing to understand and to come at it from that angle. We'd love to have a conversation with you and see if there's a fit. And if not, no big deal. We can point you in the right direction for what you may need to learn or may need to focus on. But at the end of the day, we just want to share with you what's working, be honest about that, help people really grow these mission-driven businesses, which there's a lot more there for us than the monetary side of it. We, in the last 12 months, the groups that we work with, the clinics we work with, have helped about 65,000 new patients get the help that they need. Really get back to things that they like to do, and avoid the hornet's nest that is healthcare. Traditional healthcare. So it's a big deal for us. It's a mission-driven vision for us. It's something that it's my profession. This is important to me. So if you want to work with people like that, we're the people to help you with your business. So head to physicaltherapybiz.com if that interests you. And if you just want the content, we're here for you. Been here for many, many years, and we're not going anywhere. So as always, thanks for listening and watching. We'll catch you in the next one.